All right, you guys, this is being recorded. Something I mentioned at the beginning of every one of my webinars is watch this again. I've actually changed this one around just a little bit. So if you watch another poor man's covered put, that works as well. The reason why I say that is so that it really sinks into your long-term memory. If you're newer to options trading or newer to the way that I teach, then some of the nuances might fly by you. You know, I have several rules that we need to follow in order to implement this strategy. And I want you guys to take that home with you. This is about implementation. Anybody can teach you how to do a poor man's covered put or a call spread or any of those things. But what I do is I teach you how to implement those. And the reason why that's a little bit different is because it's all about trying to increase your probabilities of success, right? If we set these up in an environment, in the correct duration, and following these steps, you will be much more likely to succeed because probabilities are going to be turning in your favor. And I'll show you how all of those levers and pulleys work throughout this webinar. And please reach out in the questions box. That's how we'll communicate. I don't want you guys to have a question throughout the entire webinar and waiting for me to answer that question because you're going to maybe miss some other things. I want to make sure everybody is clear of concept before we start moving on to the next stage, if you will. All right, but let me get a couple things out of the way real quick. My name's Eric Wilkinson. You may very well recognize me from mainstream media as the Wolfman, but I've been trading for well over 25 years now, and with my own money. I actually started out trading with my own money in college, trying to get a psychology degree, but I switched it over to finance and decided to move to Chicago and work on the floor of the Board of Trade after that. So one of my claim to fame is I've never filled out that resume that most people did right after college. I started working on the floor, and in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products and just about all market conditions. All right, this basically says any opinions, news, research, and analysis or other information contained in this webinar should be considered general commentary. Does not constitute investment advice, you guys. The reason why I put that in there is because I fully believe that I should not be giving you investment advice. Why? Because I don't know your risk parameters. I don't know how long you've been trading. Yes, in the daily market commentaries, I talk about every one of my trades that you can follow along if you want to. But at the end of the day, I may be bearish in Tesla and you guys are bullish in Tesla. So I don't want you guys to do exactly what I'm doing because of my market assumptions, all right? Bottom line is do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. All right, you guys can follow us on Twitter. Me particularly, you can follow me at Wolfman's blog. Our parent company, you can follow on Twitter at ProTraderStrat, and we are putting out a lot of content on Facebook now, so you can check out our Facebook page at ProTrader Strategies. We give out some of the daily market commentaries that I do, and Steve Primo has some stuff going out there as well, so you can get a lot of free content there, as well as on our YouTube channel. All right, so this is about building that poor man's covered put. Now, I just mentioned building the poor man's covered put isn't what we are really particularly focused on here. We're going to be focused on how you implement it. Yes, I am going to teach you how to build a poor man's covered put, but more importantly, it is how you implement that. So a couple of things we want to talk about here is a poor man's covered put. It is a diagonal spread. It's covered puts on leaps. Now, that's what most people are going to tell you is that we are looking at the leaps. I like to go a little bit closer in duration because those leaps, they just don't have a lot of volume and open interest going on out there, and the markets are pretty thin. So there's only a few eyeballs out there. I like to move it in a little bit closer. I'll talk about my duration here in a little bit, but most people will say it's covered puts on leaps. And then it is not a calendar spread. A calendar spread, we're going to be picking the same strikes. In this one, we are going to be totally picking we're going to be picking different strikes. John's saying that he can't hear me. Can anybody else hear? Did anybody else lose audio? I'm going to type to him. One thing to note, John's going through a problem where he's not getting audio. Sometimes what happens is it's a GoToWebinar thing, you guys. I can see my mic working from my end. So first thing to do would be to say, I need to log back out and log back in. As long as everybody else can hear me, I think that's good. I'm just going to double check that my mic, people can hear you. Click to mute yourself. So I have that off. All right, everybody good? Can you guys hit me up in the questions box? Make sure that everybody's hearing me, because I guess if you aren't hitting me up in the questions box, I'm assuming you can't hear me. All right, I'm believing that it's working from my end anyway. Good to hear you. Okay, not started yet. I'm starting it. I'm good to go. Anybody else having issues? Let me give it a couple of seconds. I'll keep trying to talk. All right. Ted, can you hear me? I can see you tried to reach out for a second there. All right. I'm going to move on. This is a bearish strategy. Well, and I say slightly there. Why? Well, it has to do with the short put we're going to be adding in here. And we don't want this market to just take a nosedive is what I'm saying here. So what we kind of want is we have a bearish strategy, all right? So it's bearish strategy, and then I say slightly. Well, that's because we want the market to kind of trickle down like this. We don't want a market to just take a nosedive as soon as we put on that trade, because Eric, you have not started yet, right? Audio, no audio, although I am seeing you drawing something. I'm going to talk to him real quick. Try logging in. All right. I think you got that. All right. All right, so we want to see the market slowly trickle down, because we are going to have, like I said, we're going to have a short put in here. So we're going to have like a short put, and we're going to be long a really far out duration. So we don't want this put to go into the money necessarily. We will still make money, and we have this long put out here that we can actually offset the short put, but we don't want it to happen real quick. Why? Well, one of the reasons is we don't want somebody to, put it to us. But the other thing is we would love to roll this put out in time as well. All right. So why use options in place of shorting or borrowing that stock? Well, one of the things is, Eric, I can understand covered call going up, but find it very hard place trades going down, even though I understand the put spread. Well, that is one of the conundrums that most people have, is that, markets usually go up, but there is always a bearish play out there, to be honest. And what we want to do is synthetically create a strategy where we can take advantage of that downside. So the thing is, we are going to be finding something where there is a opportunity to, everybody is kind of blowing me up here that they're not getting a sound. I don't know what the issue is. So, and I'm trying to send this out to everybody. They can see it. Getting the webinar will begin shortly. Oh, you know what? Let's hold on a second. Let me try this.
The broadcast is now starting. All attendees are in listen-only mode.
Oh, you know what? Here, we'll start over for everybody. How's that? Everybody can hear me now? Let's go back to this. Everybody good? All right. The broadcast is beginning, so let's start this all over. All right. So anyway, this is going to be on the poor man's covered put, you guys, one thing I mentioned at the beginning of every single webinar is watch this again, all right? The reason why we want to watch this again is because some of these nuances will fly by you rather quickly. And if you watch it again, it will sink into your long-term memory. So watch it again, whether it's this one or one of the other ones that I've done. I thought it was me. Everybody was. I'm sitting here trying to talk to people and it wasn't going through. All right. So anyway, some of you guys may recognize me as the Wolfman from mainstream media. I actually started trading in college with some money I had earned, moved to Chicago, and have been trading stocks, financial futures, commodity futures, and currencies on all these products in just about all market conditions. Please go over this disclaimer really quick. Any opinions, news, research, and analysis or other information contained in this webinar does not constitute investment advice. The reason why I have that in there, you guys, is because I don't know your risk parameters. I don't even know what's in your portfolio. So I don't even know if you've ever traded options before. So it would not be responsible for me to come out there and say, you guys should all do this trade. I'm here to teach you guys how to swim and not necessarily swim for you, all right? Bottom line is do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can follow us on Twitter. You can follow me specifically at Wolfman's blog and our parent company at ProTrader Strat. We also have this Facebook page, ProTrader Strategies, where we throw out a lot of content on the web, whether it's my daily market commentaries and things of that nature. That's where I talk about all of my trades, when and where I put those on, and how I take those off, whether it's win, lose, or draw. I'm not one of those guys that cherry picks a trade and says, you should have done this trade. It was the best trade ever, and it was up 650%. No, I don't do that. I just go through it and say, hey, this is a winning trade, and that's where I got in, I got out, and I followed my rules. And if it's a loser, I talk about that probably more often on a daily basis than my winners, because we need to get in there and manage the risk on those. So that is also very important, as adding trades in and around a trade that might not be going our way in order to turn those probabilities into our favor, okay? So that's what we're trying to do with the daily market commentaries, is give you the real insight as to what's going on there. All right, so this is building the poor man's covered put. One thing I want you guys to know is building this strategy is not necessarily the end all be all. There's going to be people out there that will tell you how to build the poor man's covered put. You can even probably look it up online, most likely, and find out how to do the poor man's covered put. What is different between what I do on the building aspect of it? Yes, of course, I am going to teach you guys how to build it, but what I teach is how to implement that. And the difference there between building it and implementing it, building it is just, hey, you buy a call and sell, or you buy, in this case, you know, you're buying a put, longer duration, you're selling a put near duration, there you go, you're good to go, right? No, there's all kinds of things that I talk about to increase our probabilities of success with that, because you could set this strategy up in the wrong environment, let's say, and you would see yourself losing money even if you were possibly directionally right, okay? So there's a lot of things that can go wrong if you are playing around with options and you are not implementing them properly, all right? And I'll go through all of that as we go through this webinar, but one thing to note here is it is a diagonal spread, covered puts on leaps. I'm not going to use the leaps. The leaps are like 360 days to expiration, all right? I don't like to go out that far because the markets are so thin. And you guys have heard about me, several of you guys that I've been going back and forth with have heard me talk about I like tight markets because I don't want to give up a lot of edge to get in and out of these. If you are way out there on this duration, there's not going to be very many eyeballs out there, and the market's going to be pretty wide. So you're going to have to give up some edge to get into it. It's not going to be like a middle market kind of thing where you can normally get filled. This is going to be like you're going to have to buy the offer way out there in order to get filled. So we're going to go in a little bit further, and I like basically 6 months to maybe like a year, squeeze a year and a half on the days to expiration. So usually I'm going to move inside of that though. And it's not a calendar spread, you guys, because a calendar spread, we're doing the same strikes. In this one, we're going to be using different strikes. So it's not a calendar spread. All right. Bearish strategy. Now, this is where I was talking about where everybody really got me lined up. Hey, I see you drawing, but I'm not hearing you. We'll go through this again, though. The reason why it is a bearish strategy, so we do want a market assumption to go down. But I say slightly. And the reason why is because we have that short put, all right? So if the current, line in the sand is right here, and we're going to be selling a short put, well, we want that market to kind of go like this, really. Long-term duration. We don't want something going like this or just, boom, 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 straight down because of that short put. Yes, we are going to have a long put way out there on the time horizon that we can offset this short put, but we don't want to go through that rigmarole. The other thing is I would like this put to expire worthless. I get to hold on to all that money and then maybe even sell another put further out and further down even on the duration. So keep selling these puts to help finance this long put up here. I've done it before where on one way back in the day when I first started doing these webinars, it was one of those where I just kept selling puts and ended up financing the entire trade. I don't usually hold on to trades that long. This is, I'm more of a shorter term trader and like to get in and out for a profit rather quickly. But this was a trade that I truly believed the stock was going to go to zero and just stuck with it. And it literally kept going down and or just even sideways. Even if this market is trading sideways, remember, we can keep selling those puts and finance that. So we are long-term bearish, but it's not going to hurt us if it just trades sideways to down, if you will, okay? All right, options, we want to use this in place of shorting stock. Why? Because there's a lot of reasons. You guys saw if you guys watched the synthetic shorts, we talked about some of those benefits. One of it is reduced risk with this one. When you're shorting the stock outright, you are having a lot more risk because you need to be really directionally bearish and have that market go in your direction pretty much immediately, really. You never want an uptick, really. With this one, we can have a couple upticks, and we are going to have, it's a synthetic stop in this, all right? Because remember, we got that long put. Well, what's the long put say? That we have the right but not the obligation, right? Well, when you're short something, you have the obligation. We have the right but not the obligation. And if this long put, if XYZ is trading at 100, all right? And we're going to be looking at buying a put that is in the money, which means we'll be, let's just say I'm going to be looking at the 110 strike, all right? So that's higher up. Well, what happens if the market goes higher? Well, as soon as it goes above, as soon as it's greater than 110, I have no more risk to that upside. So there's a synthetic stop in there, which makes it nice. One thing about this, though, is with that synthetic stop, we're not really out of the trade, really. It's actually a call option embedded in there. And I'll do that. I'll talk about that a little bit more when we pull up the platform. But what it allows us to do is if I'm wrong and the market goes up above my 110s, if that's the 110 area, and then all of a sudden it starts coming back off, well, I'm back in the game, right? This might be looking at a max loss and you just leave it on and it rolls back over. Well, now I'm back in. Whereas a stop, you're out, right? As soon as that stop hit, it goes to the market and you're done with the trade. And it, almost inevitably feels like when you get stopped out, you look back a couple of days later and it was a winning trade, right? I mean, we've all seen that happen. Well, with the options, that's the beauty in it, is that you can stay in the game longer. Well, I'm out. I don't have any more risk. I'm fine. I took my loss there. But then all of a sudden it rolls back off and you're back in the game. And you didn't have to watch it and put on another trade and guess, oh, is this the right time again or am I going to get ripped off? So that's reduced risk. We're going to have limited upside risk on that. And when you're doing a stock with, if you're shorting the stock and you cover it with some puts to reduce some of your requirements, it's still not going to be as reduced capital requirement as with this strategy. You know, with a short versus the synthetic short that we talked about last week, it was half of the margin. This is going to be similar to that. It's going to be about half the margin that we'll have to put up. So you're able to do this with a smaller account. You're able to spread out some of these trades over the course of, or at least spread out your trades so you're better hedged, right? So reduced capital requirements is great because it's not going to suck up our entire portfolio trying to take this. Is anybody else having problems hearing still? Everybody hear me okay, other than Raynard? I'm all paranoid now. Okay. All right, I'll send him a note. All right, so good enough. And then creating a more diversified portfolio with securities, all right? Well, think about it. If I only have $10,000 and I was going to short XYZ outright, that might take several $1,000s to do that. Whereas with this one, we are going to be able to do it with much less. I don't know that you could short a stock with only $10,000. Let's say it's $100,000 in your account and you go to short a stock XYZ. It might very well cost you upwards of $10,000 to short that stock. Well, with this, using this strategy, it's going to be much less. It's going to be less than $5,000 to be able to build it. Well, if you can use your money more efficiently, then you can create a more diversified portfolio, right? You can add more stocks to that portfolio, which is going to make you much more successful. You're going to have a higher probability of success the more stocks you have in it, all right? And there we have it, higher probability of success. You're also going to have a higher return on capital. Remember, if we have reduced capital requirements and versus what the other one was, that means that our return on capital is going to be much higher. And yes, of course, there are disadvantages. All right. There's disadvantages to this. Some of those are you have to stay active with earnings, right? Because I talked about this. I don't like to go out to the leaps, which is a full year. And if you did a full year, you would have to go through 4 earnings, right? Every quarter. Well, this one, we're going to be looking at about 180 days and maybe a little further out. Sometimes I'll go a little bit closer, but 180 days out, well, that's half a year. We might very well have 2 rounds of earnings in there. All right. So this is something that you're long-term bearish. You don't have to necessarily ride this out through earnings. If you rode this out to the expiration date, you would have to ride through a couple of earnings. So that's what this is really talking about, right? Is when you would ride it through several earnings. And I don't have a problem doing it. If you are super bearish in this underlying and you want to ride it through the earnings, you know, absolutely. The long puts will eventually expire. If you got short an underlying, you know, you can hold that for years. Something that you are going to also have, though, with that short is you're going to have to pay some other fees associated to that and maintenance on that short and stuff like that. You don't have that here. I think that the positives outweigh the benefits in that regard. Forced assignment. Now, this forced assignment is on just that short put, right? We have the forced assignment is on the short put, and that is on our, you know, days to expiration, which are going to be less than like 35 days. All right. So that is where our risk is lying, is on this short put that we could get forced assignment, you know, and, you know, that costs money. But we also, remember, have further out duration, which is like greater than 180 days to expiration, that we can offset. All right. So we could assign this put to somebody or assign it to somebody else, and they will basically then offset. So you do have to worry about this one right here, but just know that it's not like you are completely twisting in the wind. You have a long put that you can offset that forced assignment, and then you will be flat in your account. All right, so we do have to worry about that. But some of the keys to success here, one of the things we do have to also worry about, I forgot to mention about, is that you will have to deal with dividends. The nice thing is you aren't going to have to pay those dividends with this one. So you don't have to deal with the dividends. The only risk you really have to worry about is the underlying going down on that day for the dividend, but that will help us. We just don't want it to be too major of a drop. All right, so picking the right underlying. We talked about this before, and I'm going to pull up the platform. This is a tight bid ask. And the reason why we want something with a tight bid ask here is because we are dealing with different option cycles, all right? So for just having this one up, I've got a bunch of windows open here. So we go way out here on the time thing. You can see that, these are 15 cents wide here, which actually isn't very bad for being that far out. But you can see inside here, 35 days to expiration. That's the rule we're looking for here. This is what it applies to. We're not going to be applying this same rule to those further duration options. All right. This is specific to figuring out whether or not we want to trade options on this underlying. And if it's XYZ, Micron Technology, or any other one, what we want to do here is we want to look at the underlying. So we've got this one, and we could even, even if it's XYZ, who cares? We look at 35 days to expiration. And any stock that's less than $100, then we want the bid to the offer, the bid ask to be pretty tight. And we want that to be less than 10 cents wide. All right. So 36 days to expiration. Well, and the duration, we want it to be equal to somewhere around, about, let's just say, around 35 days to expiration. All right. That's what we're looking at. And this one in and around that. So XYZ is a $43 stock. It's less than $100 stock. We want these just out of the money calls and just out of the money puts to be less than 10 cents wide to the bid ask. And you can see that that is surely the case here with Micron Technology. That does not apply for these that are going out here. So, although we are going to be playing in the stocks out here on the time horizon, we don't want to necessarily apply that to here. It will work itself out where these markets are pretty good out here if you have an underlying that gets a lot of volume on a daily basis and a lot of open interest. Why? Because these guys have a vested interest in keeping an eyeball out here also to see if they can create some arbitrage or find some arbitrage and do some spreads and things of that nature. They will, professional traders will leg into stuff. So you might very well see these markets trading quite tight if you get that fitting my rule inside or in and around 35 days to expiration. All right. And if it's over $100 stock, let's just look at something like, all right, General Dynamics is the one that's pulling up. If it's inside of and this is during open market operations, you guys. So after the close, you can see for me, the market closes at 1 o'clock because I'm on Pacific time. But after the close, all of our orders get canceled. So these markets get a little bit wide. But General Dynamics, what we would want to do is move this decimal 3 ticks to the left. So we go 1, 2, 3, right? So that basically means we're looking at 17.6, all right, or 18 cents. So we want this rule to be working, where then we go down here 35 days to expiration on these ones that are just out of the money and make sure that they are inside of 18 cents. You can see that General Dynamics is not fitting that rule right now. But again, generally speaking, General Dynamics works with that rule during open market operations. Otherwise, it probably wouldn't be over there in my watch list. Same thing with JP Morgan. We move the decimal 3 ticks to the left, 1, 2, 3, and we're looking at 11 and a half cents, 11, 12 cents, whatever. And you can see that that fits that rule on the calls. And, you can just double check yourself over here on the puts. If it's doing it in the calls, it'll be doing it in the puts as well. And then you can see there's some good volume, some good open interest. And then knowing that JP Morgan fits that rule, you will notice that these during open market operations will be pretty tight. I mean, for 250 days out and you got 25 cents wide or 35 cents wide way out here after the close, that's probably a pretty good indication it'll be tight during the day. All right. Like I said, if you guys have been trading at all, traded any markets, you know that after the close, all of your orders get canceled. You hear them all clicking off as they're canceling from the day. All right. So that's our rule for that. So picking the right underlying, or the right underlying is if it is greater than $100, if XYZ is greater than $100, then we just move the decimal 3 ticks to the left, all right? If XYZ is less than $100, then we need it to be equal to or less than 10 cents wide to the bid ask, all right? And that's on the out of the money ones. That's not on the deep into the money. Most people are trading out of the money options or right there at the money. So that's what we're looking for that rule. So that's the first thing we ever do when we're like looking. We've come up with our assumption in something. This one, we have a bearish assumption. We don't necessarily know we're going to be doing the poor man's covered put right now, but we're kind of leaning towards, I've got a lot, you got to think about what your assumption is. And this for me would be, I've got a long-term bearish assumption in this. I think there's something systemically wrong with this stock, excuse me, maybe it's something with the tariffs, the trade war, whatever's been going on in the market. Maybe you just don't like their product and think that they are going to just, tank, go to zero. Right? So that's something we're looking for, is a long-term bearish assumption with this, right? Which leads us towards a long-term bearish strategy. All right, picking the right strikes. What we're going to be looking at here is we're going to be looking at the in the monies. So we're going to be looking at something. Remember, I talked about our days to expiration, and this is going to kind of, maybe I should have done the duration first, but days to expiration, I said 6 months to about a year is really where I like to go, somewhere in there. So that's where we're looking at. And for this strike, we're going to be buying. And the one that we're going to be buying 6 months to a year out, we're going to be buying about an 80-ish delta. All right. We're doing the 80-ish delta there. All right. And then the strikes that is closer duration, because we're buying this one. We're going to be buying a put in this duration. Well, we're going to sell a put to help finance some of that. Well, what happens if I just told you we were selling a put? Some of you guys that have been out there for a while, watching these market commentaries and or the webinars, you probably know what my rule is when you're selling a put. We need, 35-ish days to expiration. All right. So somewhere around 35 days to expiration is where we're looking for that one. And we're going to be looking at about the 32 delta, because that's right around a half a standard deviation away. All right. It's not a lot of wiggle room, right? 32 days to expiration, we know has, during the next 35 days, has a pretty good chance, better than a 60% chance of being tested, meaning the market's going to come down and hit that put at least once 60% of the time, but only finish in the money 32% of the time. And that's where we have to worry about this negative put. But at the end of the day, if the market comes down and hits that put, we're likely going to be at that profit target that we want to get out on. All right. So, and that's usually what we're looking for, is just that move down, hit those puts, we're out. And if it doesn't hit those puts, we're going to roll those out in time. Excuse me, I got a bit of a tickle going on in my throat. All right, one of the rules of thumb is we're selling that near term out of the money strike. That's the one I got a little ahead of myself on. The out of the money strike, the near term, you know, we said was we're looking at 35 days to expiration, days to expiration. And then the out of the money strike, we're going to be looking at the 32 delta. All right, now I kind of wrote this in backwards. I like to go out in the long term, and I'll show you when we build that thing out why I do that. It has to do with limiting some of the theta decay and stuff like that. And we want to make sure that there isn't a big difference in the volatility coefficient between the 2 months. All right, so we need to make sure that when we're building this strategy out, that we want a pretty tight volatility coefficient around those when we're picking those strikes. We've got to keep that in mind, and I'll talk about that here in a little bit. Basically what this comes down to is, you know, you hear me talking about red light, green lights and stuff like that. We want like less than 5% difference. I'm just going to put difference between the 2 months. All right, between the 35 days to expiration and the 180 days to expiration. Okay, so we want that to be pretty tight. So for instance, if this was 30%, we would want this to be somewhere like 33% or something like that. We don't want a big difference here. The reason why is because volatility affects these further duration months, the further out on the time horizon. And that's the one where we're long the put, right? So, and we're short these puts. So we don't want to be in this, especially if we let this put expire, you know, that put goes off. If we're in this, we don't want volatility to go down because that could hurt us afterwards, all right? Here, I'll show you an example of that. If I can pull this off. Sorry for the coughing in your ears, you guys. So let's hope that JP Morgan has something like this. We're looking at the 36 days to expiration. You know, somewhere between the March and the June is where we're going to be looking at. I like to go a little bit shorter, so I'm going to probably default to this. You know, yes, it is inside of 6 months out, but we're looking at these two volatility coefficients right here. 25 to 26. So that's only a difference of less than 1%, right? So that would fit that rule. I don't even have an example of one that doesn't necessarily fit. I'll just hope that NVIDIA does. 47 and 42. Now, here's something that is a rarity, and I can tell you why this is happening right now. But if you ever get it where it is greater than, all right, you know, than this one, then that immediately fits the rule, right? Because this is higher than here. That means where we're buying, we have lower volatility than where we're selling, right? So that means the premiums are pumped up in this month here. The reason why the premiums are pumped up, and we're going to have difficult maybe finding the right underlying during this, is because they have, I'll even do it in blue because that's their little symbol for it. They have an earnings right there, all right? And we're selling a put here. So we would want to avoid NVIDIA in this case because we don't want to get into the earnings play with this. This isn't a great play for earnings. It's okay to trade or have that long put on through the earnings, but it's not a great trade to have on for an earnings event. I have higher probability strategies by far for earnings than something like this. All right, so that's what we're talking about, is we would want something with a better, let me try and find something down here. Let's just look at Nike and see if it does. Nike's 24 to 27. So that's less than that 5% difference, right? We've got basically 3% difference, so that fits that rule. So with this one, when we're talking about this, I talked about we want less than 5% on this. We want less than 5%. I should have written that in green. That's a green light. You guys hear me about green light, yellow lights? A yellow light for this would be basically somewhere between 5% and 10%. Okay, and then a red light, we're going to basically say a red light is, greater than 10% difference. All right. The reason why, again, we don't want to be paying more way out. Volatility affects those further duration months. We don't want to be paying a lot for volatility. And so that's why we want it to be relatively close so we can offset most of that volatility and fit the rest of the rules. So the difference between the IV on the two legs is because the shorter dated put drops less than the longer dated put. Yes. And we're hoping that shorter dated put that we're short, goes off worthless. And then we don't care if volatility expands, right? We wouldn't mind volatility even expanding during the life of this strategy because, like I said, volatility affects those further duration options more than the nearer duration options. We can see that if we just pull this one up, we can take a look at Vega. So Vega is right here, right? And you can see that Vega is 10, 12 here. Well, look out where we're going to be buying. Vega is 26, 27, right? So you can imagine if volatility goes down, every percentage point, this volatility coefficient goes down by 1%. This premium is affected by that much. So 26 cents for every one tick down, right? This one's only going down 12 cents. So that will hurt us. So we want to try and set ourselves up for success. This is what I've talked about with implementation, you guys, right? Is this being recorded? Yes. Yes, Carrie, this is being recorded. You're probably lucky you missed the beginning because I totally fell on my face for a minute there and had to kind of backtrack. So you'll find it funny, hopefully, at the beginning. Everybody is going to wonder. I'll try and delete that, actually, so it doesn't happen. Anyway. What was I saying here? So we want to make sure that volatility expands for us because that will ultimately help us. Even if we have that short put on and volatility expands, right? We talk about this. We don't really want volatility to expand when we have a short option, but it will be offset by this long option way out here. It's going to gain in value more than this one's going to gain in value. So it won't hurt us so much, right? So enough beating that one into the ground, right? Picking the right duration. Everybody got this one all right? It's going to kind of be review. We're going to be buying out here on the time horizon. This is the put we'll be buying, and we're going to be looking outside of this. So we're looking at, like, let's just say 180 days, right? This is kind of where we're looking at. How do they do that when they do the chart breakdown? Because, for one, theta is going to break off like that a little bit, may not necessarily go down, but it's going to kind of trail off a little bit flatter as we go out. And this is where we're going to be buying. We're going to buy this put. And then, we get this theta decay. This is representation of theta decay, and it's at the money. It's not a perfect representation of how your put is going to scale out. But you can see that theta really starts picking up inside of this 35 days to expiration. So, 45's pretty good. 45 days to expiration and in is what we're looking for here. Because the short put, we want it to equal zero at the end of the day, right? We want all of that money to come out. So we want this kind of theta contraction happening to it. And then we don't lose so much of our premium out here. It kind of holds on to it. And if you're further out, the less theta will be affecting you, all right? So if this is a bearish strategy, if the longer duration vega is higher, won't this affect the trade negatively? No, because volatility out here, volatility is a plus, because volatility out here is bigger. You know, it's plus, plus, plus. Inside of here, the volatility coefficient inside of vol here, you know, it's maybe a plus, or, you know, it's a negative. Sorry. Let me get my eraser out there. It's like a 1 negative, right? Because we talked about this 26 cents out here, and only it's going to hurt us about 12 cents out here. So every 1 percentage point, if it goes up by 1%, we get an increase of 1% in vol. My strategy is going to increase over here by 26 cents on these long puts. These long puts will go up by 26 cents for that 1% increase in vol. Well, here, that 1% increase in vol, my short puts are going to increase in value by 12 cents. Right? So it will affect those front puts negatively, but the back puts are going to make up for it. If you want to see that see the platform again, right here, volatility. Volatility says for every 1% increase in volatility, vega affects the premiums by that, and it's a positive. So this volatility goes from 24.47 to 25.47. My premium on, let's just say, the 90 puts here is going to increase by 10 cents, meaning these are going to go from 144 and 152 to 154 and 162, right? Well, way out here, I'm going to be buying these in the money ones. It's actually going to be in here, but I don't want to go too far. This increases by 1 percentage point. That means my premiums increase by 25%. So these are going to go from 1040 and 1075 to 1065 and $11. So that increase that I'm long will be offset. I'm actually going to gain 13 cents on my strategy. All right. All right. And then picking the right environment. We want low volatility. I think I've gone over this. We want implied volatility percent, which I'll go over, to be less than 30. You know, 0.30 or whatever for a stock. And then for an ETF, I want it to be less than 15. Or, you know, I always talk about it as in percentage terms. This is a debit premium trade, correct? Eventually, when I get to that, it will be a premium debit. So we want low IV percent because we want that volatility to expand. We want to be in a situation where volatility can go up, and knowing our exit strategy before entering the trade. We are going to look at about getting 50% of max profit on this trade, all right? If you are really long-term bearish, it's also going to depend on your risk parameters. If you want to hold this trade for a very long time, then you're going to be looking for more than that width of the spread, and I'll talk about that for a second. Yeah, MU was a little bit high. I was just looking at that for a different example. We haven't gotten to that yet. We're going to be looking at better examples here in a minute. All right, max profit on this is the width of the strikes minus the debit paid. Now, one could say that we could have our max profit when this literally goes to zero, right? You've even heard me talk about reducing my cost basis on this trade to zero by continuing to sell puts on this trade until all of the puts I've cumulatively sold has paid off the one that I'm long, all right? But, you know, with this, you guys remember when we're looking at this, the rule of thumb here for creating this spread, and I forgot to talk about this with the strikes, we want to pay a debit which is less than 75% the width of the strikes, all right? So that would mean if the width of the strikes are $10 wide, then we would want to pay somewhere, less than $7.50. All right. Which would mean our max profit is $2.50. Now you heard me talking about we want to play this out for then $1.25. So ultimately, that's our max price. That's where our exit is. This is where we want to exit when it increases by $1.25, or we would be out at $8.75. All right. So that would be something I would circle and star or whatever. I bought this strategy for $7.50. I want to get out at $8.75. All right. Which was probably what I should have talked about during the exit strategy there. Your max loss is that debit paid. And in this case, we were looking at the example, $7.50 in that example would be our max loss. Anytime you're paying that debit spread. All right. And like I said, you can continually roll that spread out in time. And then you're going to have you're going to have the break even of the long put strike minus that debit paid. All right. So we got to take that into account, the debit paid in our long put strike. It's going to be very close to where the underlying is trading right now. All right. That's going to be basically right in and around where our underlying is at that time. And volatility can affect the break even throughout this, remember, because volatility affects those 2 months differently. And if volatility comes out of it, it could affect our break even because that debit will start going down a little bit. What do you got there, Karen? Would financials qualify as bearish in the future? I would say it would. Since trades are free now, wouldn't you make more if you have your short put every 1 or 2 weeks? Gary, great point. If the weeklies, have volume and open interest in, then I absolutely have no problem rolling out through those weeklies as well. You're right. That's something that's new. That is a great question. We don't have to worry about getting in and out of these, and I'm going to even have to change some of these slides at some point where I was like minus your commissions and stuff like that on some of the older slides. I took it out of this, but we don't have to deal with that right now. All right, so this is where I usually throw it out to you guys. Give me some stocks that we can look at, and if you're bearish on them long term, like Banu said, she's bearish I think she said she's bearish the financials going out. But remember, one of the things with all the volatility going on in the markets right now, and we've got earnings like literally looming, we need to pick something where there isn't a whole lot of earnings going on. So we want to look at implied volatility percent, which, remember, for some of you guys that are new, I see some newer faces. Implied volatility percent, we take where the current volatility is minus the low, and take that sum and divide it by the high minus the low, and that's how we come up with this implied volatility percent over here. So what this is saying is right now implied volatility, which 24 doesn't mean anything, right? 24 to 40 something means nothing, because if I go over and look at Tesla and I say, well, I got to wait till, we're at 20, he said it's got to be at less than 30%. Well, that's not volatility. It's in volatility percent, because you would see that Tesla never gets really as low as the high in Nike. This would never get down to a vol of 30. All right, unless they're bankrupt or something. But a 55 volatility for Tesla is, meeting my rule, right? It's less than 30 IV percent, right? Because we take the current minus the low and divide that sum by the high minus the low, all right? But we also have earnings right around the corner in Tesla, and I don't want to be selling an option right here. I'm not going to get any theta decay out of it or anything else. It's just going to hurt me the entire time, all right? All right, Gary says lift. Let's take a look at lift, all right? It's definitely tanking. I don't know if they've made money. They do have earnings though right there. And implied volatility percent is pretty high. But one thing we can take a look at, it fits that rule. It's less than $100 stock, right? So it fits the rule. It's a tradable option around this underlying. But our implied volatility percent, and it's broken up because it doesn't have enough, it's broken there. So, you basically take the volatility here, 65 minus 40, 45 or 48. So we've got 17 divided by 32. So it's upwards of 50 IV percent for that. So I would stay away from it for that reason. And we've got vol in and around that. Somebody threw out Nike, which I think I had up as an example. One thing we want to do is if we're bearish in Nike, maybe it's whatever, China or whatever, it's less than $100 stock. Need to look at 35 days to expiration. It fits that rule of being less than 10 cents wide to the bid offer during open market operations. What's the next thing we were looking at? The volatility. How much difference is between the volatility we're going to be? I'm going to go the 6 months one. It's 27.5 here. It's 24.5 here. All right. That's less than 5%. That's a green light. All right. Now we need to go in here and look at that 80 delta. So I'm going to look at the 110 strike here. All right. Now, one thing I was talking about with this is we want to limit some of the risks involved. And there's intrinsic value and extrinsic value. We want to pay off about as much of the extrinsic value, which is that theta decay, that we can. We want to try and pay off as much of what this option is not worth, right? This option is worth 110 to 93. So this option is really worth about $17, right? So we need to pay off, somewhere around $1.20 or something, because right in the middle, $18 or whatever, $18 to that, right? $17 is what this is worth. 110 minus 93 is 17. So one thing that's a quick hack here is to flip over here at the corresponding calls. Well, that's pretty darn close to what for government work, what the option is worth. So I bought these for $18.20. Well, I want to try and pay off as close to $1.50 as I can. And look at that, lo and behold, that 30 delta that we're going to sell pays off that. So it kind of works out that way. So just make sure that works. And usually it will when the options are very close in volatility for that, right? So the next thing we also need to do is figure out, is it less than 75% the width of the strikes? Well, we're going to take $20. Well, we take $16, and I'm just going to call it 50 cents. $16.50, and divide that by the width of the spread, which is $20, and it's 82.5. That's the yellow light. Remember I said less than 75% is a green light. Basically 75 to 85% is a yellow light, and anything above 85% is not worth doing. So that one's a little bit close. I would put that on the docket and maybe look around and see if there's better strategies for that got all green lights, maybe some of my other option strategies following those rules will work. Well, Micron, I think we said was Micron Technology, I think has, it's at 17. So that's good. Yeah, it's only at IV percent of 17, which is good. One of the things we got to look at here is less than $100 stock. That fits that rule. Does it fit the rule here? Yes. So we've got less than 3%. Does it have earnings? We missed the earnings there, so we're good. So we're bearish. We don't have any earnings that we have to worry about. I'm going to look at about that 80-ish delta. So I'm going to go with this one, the 60s, the 60 puts that are in the money. Look over here. We got to get about $1. So I might try these right here just to get the wide. So it's $20 wide, 16 is what we're paying. I think this is going to work. 16 minus 0.19 divided by the $20 wides, 80%. So it's still a bit of a yellow light, but if we were really bearish in it, I would work it. I also went a little bit further away. If I came in and probably hit that 30 delta, I'd probably meet my rule. Okay. But I think I'd like to get a little bit more wiggle room, and it's got that support right there. So yeah, if you thought it was going to come down and tag that, we would probably be very close to my 50% of max profit target if we got that rollover and hit it. All right. The other thing I was talking about, don't worry about, you could, or like Karen was saying, now we don't have to worry about premiums. Maybe we go and sell these 42.5s or something like that. It starts getting a little bit close, and then you get that really good theta decay coming out of it. And especially if it started trading sideways, and just roll it out in time. Keep collecting those dollars. You do this 10 times or something like that, you're going to basically have on these 60 puts for free. All right. Somebody else, I got time for one more. Pepsi. Let's look at Pepsi on the chart. So yeah, it looks like it could be topping out maybe. For whatever reason it is, I don't really care. My directional assumption doesn't mean anything as far as any one of you is concerned, right? So what we're looking at, it's $130 stock. Move the decimal 3 ticks to the left, 13 cents, 14 cents maybe. So you can see that fits that rule. All right, so I'm going to try and go out about 190 days because that's about 6 months out. I'm going to be looking at the, what I'm doing here is I'm cheating. I'm looking over here and trying to see where I want to, where my or where I got to pay it off. And, if I did the 84 deltas, right, I'm paying $1 there. I'm basically going to be selling these right at the monies, and I'd rather get a little bit further away. So I'm going to move it out a little bit on this one. I said 80-ish, it's kind of a pick 'em. You kind of play around with it. I figured I want to get further away from at the money and do these. So it's $30 wide, right? So it's $30 wide there, and paying $22. So let's look at this and throw it out there. $22.64 divided by $30, was it? $30. So 75.4, that's the closest we've gotten on that one, right? So that one, in my eyes, I said less than 75. That would be a green light as far as I'm concerned. So we got the green light. It's the right stock to trade. Like I said, if it doesn't follow my, the right underlying, if it's, $100 stock and the bid ask is 15 cents wide, you could look at that as being, a yellow light. The thing is, we get too many yellow lights. We don't really want to jump into it, right? Here I've got one I know is not going to necessarily work out great. Lulu, what did I say? Less than 5% to the bid ask. Well, this is 5 to 10. That was in that yellow light region. It's less than, move the decimal 3 ticks to the left, 19 cents. Okay, well, we've got a yellow light there. Actually, during open market operations, it usually works. And then we come out here and we can go and look at the buying the, what do we want to do? We could do the 80 delta. I want to get $5 and some odd cents. That's a little close. So let's go. Let's look at the March. That's just outside of there. I think that the difference, see, when you get too wide on these, I'm paying way too much, right? All the volatility is out there in this April. So it's making me, all of this has a lot of extrinsic value in there. And it makes it very difficult for me to come in here and pay off that extrinsic value, right? Because there's not as much volatility in these. So that's why I'm going to start now looking at the March on this. So I'll look at the March and look at the 80-ish delta. So, oops, I'll just buy that one. So $5 still. And then sell the 90s is what I'm going to have to do here to do that. So we've got $50 wide, and it's going to be 82%. So it's all of those end up being like yellow lights, right? Because if I take 41.34 and divide that by 50, it's going to give me 82% or 83%, 82%. So like I said, a lot of yellow lights. I think I would move on to something else that has a higher probability of Carrie's asking, what happens if it gets called away? Right. These stocks, you're talking about the puts where you're short, right? If somebody assigns you that, well, you have this long that can offset it. It's not a great scenario, and I don't think that the no commissions has that assignment risk charge in there, but you can offset it because it's further duration, right? You don't have to worry about it. I mean, you have to worry about it a little bit, but you know, if the market comes down and tags these and hits, you know, sells off to 190, my profit target is going to be met at that point. Somebody was, how about bearish XLB for long-term bearish ETF? Yes, James, you can do ETFs on this. I would do less than 15 IV% for the ETFs. All right. All right. Is that enough examples, you guys? Select stocks with no dividends. Actually, dividends aren't going to hurt you necessarily because the dividends are, you know, the dividends should lower the value of that stock. So usually on the ex-dividend date, that stock lowers by the value of whatever that dividend is. Because, you know, the people buying it afterwards aren't going to get that dividend, so they're kind of compensated for it. So you don't have to worry about that necessarily. The market should drop for you. It should help you in this instance, but it doesn't always drop on those dividends. No assignment charges or fees for TD Ameritrade. That's great news. Because actually those assignment fees could get expensive, especially on, I think E-Trade charged a lot. So that's good to know. Carrie's all over it. All right, that's all I got. Other than you guys, like if you guys want to, like I said, this is all about implementation of the strategy. It's not how to build a poor man's covered put. I mean, if I wanted to just tell you how to build a poor man's covered put, this webinar would have been done in 5 minutes, right? We spent an hour going over different questions to make sure we're all clear of concept and making sure that we have the right environment and the right implementation of these strategies, because that is what is key. It has nothing to do with building it out. Anybody can teach you how to build something out. They're probably going to tell you to do those leaps, and I'm going to tell you not to do those leaps because there's no eyeballs out there, and you're going to give up way too much edge. And if you give up too much edge, that eats into your yield. And if it eats into our yield, then we have less profitability. So stay away from that. All right, volatility crush, you guys, is huge. That is one of the favorite things I like to trade. We're doing this all regularly. It's, you know, you're saving over $3,000. We don't usually give this deal. This is probably the last week for this deal, you guys. You can type this into your URL. Otherwise, I have it sent out right now in the chat window. We've been going back and forth in the questions box over there in the chat window is the direct hot link to this for less than $300. But volatility crush, how to take advantage of volatility is the key to high probability trades, you guys. I mean, we talked about the volatility and how to take advantage of it here. We talked about volatility crush. That allows you to get in and out of the trades. Floor trader hacks, I showed you one of them already, basically. You know, how you can tell what the extrinsic value is by looking at the corresponding options, right? If you're doing in the money options, you look at the corresponding out of the money option, and that is very close to what it is. I don't need to go and figure out to the penny what my extrinsic value of it in the money option is. This is quick and easy floor trader hacks that you guys can take advantage of. Options basics, I probably shouldn't have stripped that out for people that aren't going to see that, but options basics, I go through all the details, you know, of easy ways to remember some of these options basics also. So it's not even just talking about, you know, the basic option stuff that most people are talking about. I give you guys little nuances, like I mentioned, theta, the thief in the night that comes and steals your premium. You know, that's a great way to remember what theta is. It's the thief. It's the premium stealer. You know, how does that happen, and all of those things, and trading with the dividends. The dividends, stock splits, everything in that, and then finally the learn how to trade options, even setting your screen up like I do. You know, I like to trade the market profile. That's something we used to use on the floor when we were trading, because it gave, you know, I mentioned at the beginning, I graduated with a finance degree. I started trading with a psychology degree. And when I was working on the floor, I told those guys, I was like, my psychology degree is so much more beneficial in trading than my finance degree, because it really makes you think a different way. So market profile is a great thing to trade in and around, because that gives you the psychology of the market and all kinds of other things on learning to trade like I do. The way I trade is a lot different than guys even on CNBC and stuff. If you guys have any questions, reach out to us at 310-598-6677 or trading@protraderstrategies.com. And other than that, I want to thank you guys all. Later webinars will deal with different option components and how I trade those, when and where I find them appropriate, especially if you watch the daily market commentaries. That's where I talk about all my trades on every given day. And again, here's that link. It's not a hot link. The hot link is over in the chat window, but if you're watching this on tape delay, you're going to have to type this into your URL. And again, there's the phone number and email, trading@protraderstrategies.com. All right. So take advantage of this, guys. You guys, it's a great deal. I mean, we're talking probably a month's worth of webinars if you watch them every single day. Sorry, my spinner is going crazy. You know, I'm thinking there's probably 50 hours of content there that you can take advantage of. Why is this called the poor man's covered put? Which is covering out there? Well, great question, John. It's called the poor man's covered put because if you did a short stock, right, and then you put in a short put, well, the short put really creates that spread. And what happens is once you hit the short put, then you know you can't make any more money. It's kind of like when you do a covered call. Think about it this way. If you do a covered call and you are long the stock and you sell a call, right? Well, you're limiting your upside potential. With this, if you shorted a stock and you sold that put, it's the opposite play. You're limiting your downside. But with that short put, you get to collect a premium, which is brilliant. I mean, if you're long options or long stock in your portfolio, you should be doing covered calls all the time, if you were to ask me. You know, when you have all long portfolio, you need to add some short deltas, and this is a great way to add some short deltas to your portfolio. But we talked about this. Our return on capital is much higher with this. What we have to pay out, you know, our margin requirement is much less for the strategy we just built out. Therefore, they call it the poor man's covered put. If you did long stock in a covered call, right, a covered call strategy, well, a poor man's covered call is a lot cheaper than going out there and buying a stock and covering that stock, right? So that's why they call it a poor man's covered call or poor man's covered put, because your outlay of cash to build the same exact strategy as shorting the underlying and putting a collar on it, or getting long a stock and putting a collar on it, It's much less expensive. So for those of us that don't have billions of dollars, you know, and or want to have a more diversified portfolio, this is the strategy to use in place of that. Yeah, what do you got? So the short put is the cover here. Yes. Yeah, like if you had a long call that was in the money and you shorted a call, that's your cover. Or if you were long a stock and you shorted or did a short call, that's your covered call. In this case, we are on a bearish trajectory. So we would be either getting short the underlying, right? And we're covering that short underlying. And or we are doing the poor man's covered put, and the cover is that short put, that covering that some of that risk, right? I have a put on an MU, the November 15, and paid $3.25. It is now $7. Would you sell it out or sell a put in the October? Carrie, that's a great question. Now, I'm going to throw this back out to you. Would I do it or would you do it? If I was still bearish in Micron technology, then I would probably start selling some puts around that. All right. I would try and pay off that debit, right? And even if you're even selling puts for like 25 or 30 cents, I would try to start selling some of that off. If I was still long-term bearish in Micron or MU, all right? If your gut is switching a little bit on you and saying, I don't know if I like this trade anymore, then I would pull it, all right? I always talk about this, you know, that goes back to the psychology of the trade, right? I say that anytime there's that gut instinct that tells you I should get out of a good trade or I should get out of a bad trade, guess what? That's the time to get out of that trade. Don't ever second guess that gut instinct, because it's your limbus and your limbic brain can process so much information, because, you know, it's like risk reward, you know, for every risk there's a reward. Well, your limbic actually can't communicate to you. It can't talk. It can't send emotion. It can just tell you something's not right or something's is right. Okay. And that's why I always say go with your limbic, no matter what it is. If it's a relationship, there's something that's getting you and it's like, I don't know about this. Well, that means there's something wrong there, and I would avoid it. So if it's saying, if you're just sitting there going, listen, I'm right, you know, yeah, it's something to do with news and they're wrong. And I've done that before where I'm wrong and I feel confident about it. Then I would try and do something and be mechanical about it. You know, that's the other idea with this, is always try and stay mechanical, because then you take the emotion out of this. If you still believe that it is bearish and it hasn't maybe broken a resistance area where you were thinking or any of that stuff, then yes, I would absolutely go in there and try and sell some puts in there to lower my basis on that. Does that help? Right, the limit. Yeah, I know. I did the limit. The it's incredible. Your limit. Yeah. Okay, JQ. Good to see you're back in the house. You remained quiet throughout most of the day, though. Did get me in the end. All right, guys. I'll let you guys go. Thank you guys for sticking around. If you can't take that, take it easy. JQ, I know you had to erase that at least once before you, when you started throwing about back and forth with me. All right. Take care. Yeah, Carrie, I just need to drink more water, right? Have a good one, you guys. Bye for now.